lecture, we're examining the treatment of cost recovery for tax purposes. Cost recovery is effectively depreciation. We'll describe the type of assets that can be depreciated, how the tax code treats depreciation, and what are the special cases for depreciation under the tax code. Under the Internal Revenue Code, depreciable property includes those real and personal property items that are used in a trade or business or for the production of income if they're subject to wear and tear, are subject to obsolescence, and have a determinable useful life. So what does it include? By realty, it means real estate, buildings, and anything affixed to that property. The land on which the real estate sits has value, but it doesn't have a determinable useful life. So the land on which real estate sits is not depreciable, but the building itself and the fixtures on the building are. It also includes personal property. So for a bakery like Sugarista, it includes the display counter that you see through the window there, as well as the utilities that she uses to create her baked goods. The fridge, the stainless steel tables, and the oven. Let's review a few terms that you'll hear throughout this discussion on cost recovery and the modified accelerated cost recovery system. First is tax basis, which is the taxpayer's investment in an asset or property and the value on the books of unrecovered dollars represented by that asset. When you acquire the asset, you pay a specific price. That price includes the sales tax, the installation costs, the testing costs that are related to getting the asset in place and functional. Cost recovery begins on the date on which the asset is placed in service. So if the Sugarista bought an oven on March 1st, but wasn't able to use that oven until April 1st, the cost recovery begins on April 1st, the date on which she's actually able to use the asset. As she uses the asset over time, she reduces the basis by a portion of that cost. Once she has depreciated all of the asset's basis, she can't take depreciation anymore. The IRS created a system called the Modified Accelerated Cost Recovery System, or MACRS, to record the tax value of depreciation. This is based on a union of wants and desires. The company that acquires the property wants to minimize the tax costs. In an ideal world, they would want depreciation to be as high as possible so that their income is lower and that they don't have to pay any tax on that income. But the IRS wants the fair tax of their own. They want the tax that they collect from these companies to reflect the reality. So the compromise was the MACRS, MACRS. MACRS calculates depreciation based on three factors. First is the recovery period. It assigns each asset to a different group, 3-year, 5-year, etc., based on its useful life. This useful life is generally shorter than the length of time that a business or business owner will actually use the property. So they get to take the acceleration more quickly than they would ordinarily. The depreciation method. This is contingent upon the recovery period. The shorter lifespan property items use double declining balance, while the longer lifespan items use 150% declining balance. Finally, depreciation convention. This assumes when the asset was put in service and removed from service. In the year that you acquire the asset, it generally takes a half-year convention, regardless of when you put the item into use. There's an exception to that rule called the mid-quarter convention, and we'll examine that in more detail later. Now let's take a look at an example of the personal property depreciation schedule. This appears on IRS publication 946. As you can see, it assumes the half-year convention. Each column represents the percentage rates for a given class of property. Within the table, you would go to the year in which you're computing depreciation and find the appropriate percentage that you would record on your tax return. For example, property that uses the half-year convention is within the 10-year class and is put into service takes 10% of the cost in that first year. You can calculate this based on the double declining balance method of depreciation. Ordinarily, 10-year property would take 10% each year under the straight line method. Double that is 20% in the first year, but we're assuming a 6-month convention, hence 10%. See how that comparison works out. The straight line computation versus the maker's calculation. I will compute this on commercial kitchen equipment that has a 10-year lifespan and a residual value of $2,500. Remember, with straight line depreciation, compute the total amount to be depreciated, which is the cost less the residual value. This gives you $10,000 to be depreciated. Over the 10-year lifespan of the property, you would depreciate $1,000 per year. So therefore, the first year's depreciation is $1,000, and every year's depreciation until the value is all used up. Now let's compute the depreciation under MACRS. Same property, same lifespan. The first step would be to determine the appropriate annual percentage from those depreciation tables. As we just examined, under a half-year convention, for a 10-year class of property, the first year's depreciation is 10%. Now, how do we know that we're using the half-year convention? Because the property was put into place in March. As long as the property was put into place prior to the last quarter of the year, we generally use the half-year convention. So in the next step, you multiply the annual percentage rate from that table by the cost of the property. This is another difference between straight line depreciation. The straight line depreciation assumes a residual value. Makers does not. So in the first year of usage, we're taking a tax depreciation of $1,250. As I alluded, MACRS uses the mid-quarter convention when more than 40% of the cost of the property is placed in service during the last quarter of the year. You can see the table there. Let's look at what that means for Sugarista. Assume that Sugarista has a January 31st fiscal year end. She sells her 3 small freezers on November 1st, purchasing instead a commercial freezer, which is 7-year property, on November 15th. Her purchase time frame puts her buying the property in the final quarter of her fiscal year, which means if she were to take 6 months worth of depreciation in the year, she'd be at an advantage. She could be taking more depreciation than she would otherwise be entitled. To keep unscrupulous business persons from taking advantage of this, the IRS created the mid-quarter convention. The Sugarista's property is 7-year property, and we're computing the depreciation for the first year. We'd find the appropriate location on the table and multiply that by the cost of the property. In this case, we take 3.57% of the purchase price of the freezer of $10,780. The rules for makers for realty are similar, but there's a few key differences. Real property has a longer recovery period. Residential realty uses 27.5 years as the lifespan. Commercial property uses 39 years as the lifespan. And land improvements to either of those properties take a 15-year recovery period. For each of the real estate classes, depreciation is straight line based. And as far as depreciation convention goes, real property uses the mid-month convention. Here's an example again from IRS publication 946 that shows the depreciation schedule. This one happens to be the schedule for residential property, which takes the straight line depreciation over 27.5 years. Since it uses the mid-month convention, you compute the depreciation for the first year based on the month in which you placed the property in service. So, for property that's purchased in the 8th month of the fiscal year, you would multiply 1.364% times the cost of the property. In the subsequent years, it would be relatively stable until you sell the property. Let's look at a couple of special provisions of makers. The first of which is the Section 179 expensing. This provision of the Internal Revenue Code allows small businesses to immediately expense up to $1.02 million of personal property acquired during the year. This is subject to certain limitations. The maximum amount of personal property acquired during the year cannot exceed more than $2.55 million, and the amount of personal property expensed immediately cannot exceed the taxpayer's trade or business income. This provision of the Internal Revenue Code, again, is a compromise between the businesses that benefit from it and the IRS. The businesses, again, want to minimize their tax costs, but the IRS and Congress, indirectly, want to encourage businesses to purchase depreciable property, put that property into service, and then hire people to run that equipment. This represents that compromise. A couple of examples to show how this might work. Let's assume the Sugarista installs a commercial freezer, which is 7-year property, at a cost of $10,780 on November 15th. Her business income for the year was $15,000. Let's look at the 3 requirements. Can she expense that equipment immediately? The equipment does cost less than $1.02 million. We don't know anything about the rest of her personal property acquisitions, but if her business income for the year was $15,000, it's probably not a big spender. She's probably not making property acquisitions in excess of that limitation. So that requirement is also met. The cost does not exceed the trade or business income. Her business income for the year was $15,000. The cost of the equipment was $10,700. So she's good. If she wants to immediately expense that property, she can. The results would be a decrease in income by the amount of the property. The property basis on that commercial freezer would be 0. And she would not be able to take any future depreciation on that property. Now let's see what would happen if one of those conditions was not met. In this case, The cost requirement is violated because Kimberly has acquired 1,000 commercial freezers at a price of $10,500. She's limited to expensing only the first $1.02 million on the purchase. The remaining $30,000 becomes the basis of the property on her books. She would use MACRS depreciation for the 7-year period to depreciate the remaining property basis. Now let's see what would happen if we violate 2 of the conditions. In this example, the sugarista has already purchased 250 ovens, each carrying a cost of $8,250. The sugarista did not elect the Section 179 deduction on the ovens, and that's an important call out. The Section 179 deduction is an election. The taxpayer can use all, some, or none of the appropriate deduction amounts during the year that the asset is put into service. So let's see what that would mean for this case. The sugarista purchased 250 ovens that each carried a cost of $8,250. During the year, she's already acquired $2,062,000 worth of property that can be depreciated. The total cost of her property acquisitions is the sum of the amount she spent on the ovens and the amount she would spend to acquire the commercial freezers. This puts her at total property acquisitions for the year of $3,112,500. For every dollar that a taxpayer exceeds the property limitation of $2,550, it reduces the amount of the available deduction 1-to-1. So in this case, we would compute the allowable Section 179 deduction by subtracting the total cost of the property acquisitions minus the limitation set forth by law. This means that the sugarista can take $562,000 worth of depreciation in the year in which she put the freezers into service. So what would this look like when the cost exceeds the requirement and the composite of all personal property acquisitions exceeds that limitation? The amount that can be immediately expensed is reduced on a 1-to-1 basis by the amount by which it exceeds the limitation. The property basis is then the cost less whatever was immediately expensed, in this case $488,000, and that $488,000 would be depreciated over the remaining life for makers' purposes. So now let's see finally what would happen if the sugarista's business income was less than the price of the deduction. We've still got the allowable Section 179 deduction of $562,000, but now we're constraining it to her annual business income, which was $450,000 for the year of the acquisition. This means that she's limited to a Section 179 deduction of $450,000. Because she was eligible to $562,000 worth of Section 179 deduction and can only take the $450,000, she can carry the balance forward. This is only true when the business income isn't enough to cover the deduction. Another special MACRS provision is the bonus depreciation provision. Prior to the Tax Cuts and Jobs Act of 2017, companies could take 50% of additional depreciation for new property placed in service. The Tax Cuts and Jobs Act of 2017 expanded this so that companies could take 100% of depreciation in the year in which a new property is placed into service. What this means, just like with the Section 179 deduction, It occurs in the year in which the property is placed in service. If you're not placing the property, you can't take this deduction. If you miss it in the first year, you can't make up for it in subsequent years. It's taken after the Section 179 deduction or in place of the Section 179 deduction if the limitations were exceeded. And just like with the Section 179 deduction, future year depreciation is computed using MACRS on the remaining basis. This is computed by subtracting the 179 expense and the bonus depreciation from the cost of the asset. So an important question to ask is, if you can expense it all, why wouldn't you? And there's a number of reasons why this is true. For example, if you expect that marginal tax rates will increase, you'd want to spread that depreciation out over a longer period of time so that you can offset income in future years, not just the current year. Depreciation deductions might violate excess business loan limitations and net operating loss carry forward limitations. And finally, certain assets are excluded from this provision or greatly limited. If you're depreciating one such asset, you might not want to use the deduction if you can't take full advantage of it.